Yeah, well, hello, welcome to, and we are going to be getting into high percentage trading. Okay, now you've likely heard my 10 trade analogy. The 10 trade analogy is where a trader, let's say they're going to make 10 trades over the next, let's just use a period of a month. And that trader does lots of homework, does lots of analysis, goes in, looks at everything, and the trader only picks the trades that they think are going to be the best trades. And they make them, and sometimes they fail. In fact, 3, 4, maybe even 5 times out of 10, those trades are going to fail, and they are not going to produce results. That is the reality of trading. And one of my favorite stories to tell is that, my first year or two of trading, if you ask me, Rob, can you make money on every trade? I'd say, no, that's ridiculous. And they say, what about the next trade you're going to make? Oh, yeah, for sure this one. This one's a no-brainer. I've got this one. Well, again, the only trades you're going to make are ones that you are convinced are good trades. And that's really the heart of what we're talking about here is high percentage trading. Is we want to make sure that the only trades we're taking are very, very well thought out and very deliberate. And frankly, have a really, really good plan. And so this is really what high percentage trading, the concept of it, is all about. And you're going to hear either myself or other traders talk about an edge. An edge is basically, what are you going to do? What are you going to do that's going to be better than the amateur out there that's floundering around and doing something different, who is not being profitable as an FX trader? What are you going to do that's different? What are you going to do that's going to put you over the hump to where you say, hey, this is what I do? And that's really what it comes down to, is that there are really hundreds of ways, thousands of ways to make money in the market. There's people that do it where they hold their positions for a couple hours. Some hold them for a couple minutes. Some hold them for a couple days. Some hold them for a couple months. The real question is, how are you going to make money in the market? And that's really what encapsulates high percentage trading. The first thing is, again, be very deliberate. The FX markets are open 5.5 days a week, 24 hours a day. There's a lot of time to be an idiot. There's a lot of time to be stupid. And looking back on my first probably 10 years of trading, I'm definitely embarrassed to say that I made many trades out of boredom. And I had to come to the realization that my personality, I need action. I need action. I needed to be in a trade all the time because my personality craves stimulus. I'm a very strong E. I'm an extrovert. Very strong extroverts. If you're like me, you crave the action. When I was a kid, I was an adrenaline junkie. Everything you could jump off, I would jump off. I needed that stimulation. As a trader, that's a very deadly thing because you only want to take the absolute best trades. So a big part of just trading in general and becoming a trader is to get over those impulses. And if you are a strong E personality like myself, this is going to be one of the battles that you face, is that you're going to want stimulus and you're going to want to be in a trade. You're going to want something to do. On the other hand, if you're a very strong introvert, you actually have the opposite problem where you are going to be very reluctant to get into things. You're going to worry about things. You're going to second guess yourself. In the end, your trading plan should be very deliberate. And it's going to be about you. How are you going to do it? When are you going to get in? And how are you going to get out? And that really is what we're talking about in a nutshell. So there's going to be 4 components of high percentage trading. And that's really what this session is going to be about, is really to map out some of the things you've already learned and some of the things you've already implemented and some of the things you've already practiced. And there may be some things in here that you haven't yet got to. But I really wanted to go through the steps of the trade because we have a lot of people that just start on chart setup, number 3. That's where they start. And there's a whole lot more that goes into it. So let's start at the beginning. In our earlier sessions in Forex 101, we talk a lot about time frame. We talk a lot about calendars. We talk a lot about energy. We talk about when there's sometimes that you should trade and sometimes you should not trade. And one of our sayings at Maverick FX is it's just important to know when not to trade than when to trade. Because there's going to be lots of times where the Forex market is untradeable. And what I mean by that is it's random. It's random. There's no real strong trends. Things are just floating around. Now look, there's always movement. There's always movement. Any time of the day you can turn on a system and get a quote and things are moving. That doesn't make it a high percentage trade. A high percentage trade is a very, very deliberate entry point that is designed to be the optimum moment. So this is one of the things that people just don't understand when they get into Forex trading. We actually spend not a ton of time on this, but a lot of time to make sure that our traders do understand that we are in a global marketplace. And during the 24-hour session, there's going to be periods of time that are good and periods of times that are not good to make trades. People who just start with Forex trading, they have no idea about this. They just think, oh, the market's open, the market's moving, I can make a trade at any time. And I've heard people say, oh, I get home from work at 5 p.m., that's perfect, I can put some trades on during the Asian session. Well, frankly, that's not sometimes a great period of time. So as you know, we have the Asian session, and then we have the European session, and then we have the American session. So we talked about this in an earlier session. We talked about how where these overlap are actually really good times to trade. And the reason why we say they're good times to trade is because, number one, there's volume. Volume means liquidity. It means there's a lot of people participating in the market. And if there's a lot of people participating in the market, you get less wild swings. You get less wild swings because there's more liquidity. Less wild swings means more predictable behavior. And that's really what we're looking for in the world of trading is the markets are always moving here, here, and here, but at certain times, hey, when this chart pattern forms at this time of the day, it usually makes a good return. So these are the periods of time that are really usually almost every single day you can count on them being decent trading sessions. And then this is my personal favorite, is the morning of the American session. You still have the Euro session going and the American session opens. This is the biggest volume period right here during the day. This over here where the American overlaps the Asian is going to be one of the worst times of day. Now let's talk about the danger zones. And we talked about this in previous sessions where we really talk about there are times where it is not a good time to initiate a new trade. And we call these the danger zones. And you can see here that period when the United States banks close, which is 5 p.m. Eastern time. Yes, at that period of time, the New Zealand banks have opened. So again, that's why the Forex market is open 24 hours a day, because there's always a bank open participating in Forex trading. However, that volume is pretty low. And then the Australian banks open up, and then the Korean banks open up, and it isn't until the Japanese banks open up where there is a significant amount of people trading the market. Now look, this is a normal average day. If there is some news that is going on, then it could be a very good trading period. But remember, we're looking for periods of energy. And so just on a regular basic day, these are typically low energy periods. Again, low energy means low liquidity, low volumes, less predictability, and it just isn't as good of a time. And then also, right at the end of the Asian session and the beginning of the European session, but before, like the UK opens up, So the UK, their market opens up at 1 a.m. Eastern Time. So that to me, again, that 11:30 p.m. to 1 a.m. p.m. Eastern Time is also a dangerous moment. So if you think about this, you're going into Forex trading, you're looking for trades, but we're looking at periods of time where there's actually trends and movement going on, not just random movements just because the market is open. But when are there a lot of market participants playing the market that are causing there to be sizable moves that we can go in and actually make a profit? So again, we have the Forex time calendar telling us, hey, there's certain points of the day that are better than others. And then we also have the weekly economic calendar. Now, this is something we go over all the time, and this is kind of something very important to a Forex traders. You do have to be dialed into what's going on. Because during the week, there are also going to be predictable moments where you know that if I get into a trade at 9 a.m., I know that because there is a big report at 9 a.m., there's going to be a lot of energy and a lot of market participants. And I want to be playing during that moment. So we can look on the calendar and we can see that there could be central bank announcements. Again, the Australian Central Bank is announcing. There's also going to be GDP reports. Companies announcing major reports that are going to really significantly affect the value of those stocks. And then, of course, economic reports. We've got unemployment reports, we've got job reports, we have inflation reports. All of these things create energy. Now, most of the things on the calendar are going to be very specific to certain currencies. For example, on this calendar, we have the Reserve Bank of Australia is making a rate statement. That is not going to affect the Swiss franc. It is just not. But it absolutely is going to affect the Aussie dollar. So we know that if we are going to want to trade the Aussie dollar and we want to find a period of time where there's a lot of activity on the Aussie dollar, then we know that on Tuesday, early Tuesday morning at 12:30 a.m., there's going to be a report that is likely to cause the Aussie dollar to have a sizable enough move in one direction for us to make a profit. And if we wanted to trade the CAD, we know that on Thursday, they have an employment report at 8:30 a.m. We know around that period of time, there's a high likelihood that there is going to be some activity to where the CAD is going to be much better. So the first thing we really need to do in high percentage trading is really not about the trade itself. It's about the market backdrop. Is the market tradable? Is really what it's about. Is there enough energy out there to move a currency pair far enough to justify the risk I'm going to take with my capital? And if it's just fluctuating 20 or 30 pips up and down, if you're going for more than 20 or 30 pips, then it's just not the right time. We have to trade the market in front of us. It's one of our sayings at Maverick. Don't trade the market you want it to be. Don't trade the market you think it should be. Trade the market in front of us. And we want to make sure we're trading the right market. So again, time energy, it's a very important one. It's actually one that I haven't really seen anyone else talk about outside of Maverick. All right, once you get the time and energy part where you say, okay, we meet on every Sunday night. We talk about, hey, I think Monday is going to be a good session. Tuesday is probably not very good. Wednesday night, we've got a report. We actually plan out when we're going to be actively trading. And by default, we're also planning when we are not going to be active trading. The best thing you can do is in those periods of time where you're not going to be actively trading, turn off your system. Turn off your quotes. Yes, you can check in every now and then, but the more you watch, the more likely you are to get into a position. All right, once you've determined your week, you look at the calendar, you look at the sessions, you look at your lifestyle. Next is about finding the correct pair. This is another one, and you're going to hear me really hammer on this every Sunday that I'm in the FX room, because people ask me, Rob, take a look at dollar Swiss franc. And you're going to hear me say, hopefully I hold my sigh, why are we looking at dollar Swiss franc? If dollar hasn't been going anywhere and Swiss franc hasn't been going anywhere, why would we trade dollar Swiss franc? Remember, the best trade we can make, the best trade is we pick the currency that goes up the most, and we play it against the currency that goes down the most. That's the best trade we can make. We're not just pulling up a chart, and that's what most people do that's wrong, is they don't do this. They don't do this. They just turn on a system and they say, oh, let me take a look and see what pound dollar is doing. Oh my gosh, look at that, pound dollar. It's in a nice trend. I should buy it. Well, how do they know that pound dollar is what they should be trading? So the next step of a high percentage trade is going to be relative strength and weakness. So you go through the time and energy and decide what days you're going to trade. You decide what currencies you're going to trade. And this is the determination of which currencies you're going to play this week, is relative strength and weakness. Now, again, we've gone through this in other sessions. We've talked about how do you identify the strongest, how do you identify the weakest, but then you're going to pair those together. Now, every Sunday and every Wednesday, we're always going to be looking at past performance. What did all the currencies do over the last couple of days? Because it's actually going to tell us where the action and the movement is. Now remember, if the euro went up during this period of time, remember the only way anything, a stock, a bond, a currency, a commodity, the only way that something can go up in value is if more people bought it than sold it in the past. That's the only way things go up in value, was that there was more buyers than sellers, so the price went up. So when we're looking at this past performance, we could see that last week there was a buy-sell demand imbalance in the euro where there was way more buyers than sellers. Now look, that might end. That might end. But as far as if we look at it right here, right now, this is what's happening. It's telling us, okay, right now there's a lot of people that are buying euro. And if that doesn't change, I should be jumping on long euro. And then here, the CAD is the weakest currency. So what this chart is telling you is that the best trade you could have picked at the first of the week, if you made a trade and held it to the end of the week, you should have been long euro, short CAD. And if you did that, you would have made basically 1.6%. That would have been the return on the week. That was the best trade you could have made. So if you think about it, if we were to make this graph 5 days from now, the trade you want to pick, you would want to pick and pair the strongest against the weakest. That is your job. That's what you're trying to do, is find out where that is. And this chart right here shows you this is where supply and demand is last week. Or we're looking at it over the last day. Hey, over the last day, maybe the franc was a little bit stronger than the euro, so we want to play franc. But this is going to tell us where to go look for trades. And then we also look at our currency baskets, and we covered this in other sessions as well. At Maverick, we've put together these proprietary trading baskets, where currency baskets, where basically there is no symbol that looks at the dollar versus all of the other currencies. Now, there actually is something called the dollar index, and the dollar index is supposed to measure that. Here's the problem. Like 50% of the dollar index is the euro-US dollar cross. So it's really measuring it against the euro and then some of the other little currencies, but it's not equally weighted. We've equally weighted it, so each of the other 7 currencies we take a look at have been equally weighted against the dollar. This chart here is the yen. So this is a chart of the yen, and the yen is compared against all other of the 7 currencies. And it basically draws a chart of that. And you can see we have a chart pattern here. we've seen that when the yen gets down to this level of support, it tends to bounce. When it gets up to this level of resistance, it seems to hit some problems. And then you can see that we've actually kind of broken out of this little triangle here. So these currency baskets are also going to give you some insight of which currencies are breaking out on a technical basis. So we've looked back at what is the current supply and demand right now, or at least where it was at last week. We take a look at the current chart. And remember, we're trying to pair up the strongest currency against the weakest currency. That's all we're trying to do. Now, once we do that, we have basically our watch list. So maybe this week we've decided that the Aussie dollar and the Kiwi are likely to be the strongest. And we've determined that the Swiss franc and the euro are likely to be the weakest. Well, we are going to start the week off looking for setups only in Euro Aussie and Euro Kiwi. And then maybe Aussie Swiss franc and Kiwi Swiss franc. Those are going to be the only ones we watch. We're not watching Euro dollar, we're not watching pound dollar because our analysis told us they are not going to be the biggest or weakest movers of the week. Once we identify what currency pairs we're looking at, then it all comes down to finding a chart setup. So if we have determined that this week we're going to be focusing on Euro Aussie and Euro Kiwi, we're going to go watch those charts and we're going to basically look for an entry point. Where is a really good entry point to get into those? Now this is where it all comes down to technical analysis. Now technical analysis is going to be your next series after this. It's called the FX Master. And we go in and we basically make setups. A setup is just a fancy word for a checklist. Basically, you're going to have a checklist where you say, I am not going to click any button until I have all of these things lining up at the same time. So as you can see, it's very deliberate. We're not guessing. We're not just jumping in. It's very, very detailed on when exactly you get in. And we're determining everything up front. We're determining, okay, this is how we're going to enter. This is what we need to see. We're going to decide, are we going to take our entire position at once? Or are we going to scale in to the trade? Or what's called pyramiding. Pyramiding is the best thing about Forex, in my opinion. I absolutely love it. And this is where if you wanted to take, let's say you wanted to take a one lot position, $100,000 worth. Now you could go in and jump in, take a $100,000 position, and then put in a stop. Or you could put in a third of your position and put in a stop and see if it works. And if it works, why don't you buy the other third and then move your stop up a little bit? And then if it keeps working, why don't you buy the next third and then move your stop up? It's a great way to get into a trade where there's not a lot of risk at first. And as the trade starts looking better, you're actually adding into your position. We talk about this pyramiding if you don't know what it is. The other thing you could do also, you can take a third of a position and have a very, very wide stop. You might have a stop 3 times wider than you usually would. That's going to give that trade a lot of room to move around. That's a perfect thing to do in a high volatility environment. And then when it goes your way, you add more. So again, it's all planned out. You planned out when you're going to get in. You planned out how much capital and how much risk you're going to put into it. And then you basically are going to do a risk-reward calculation that basically says, is the reward enough to justify putting your capital at risk? If it's not, then we don't do it. If it is, all right, then we take a shot. So again, this is going to be a big part of your qualification training. And again, technical analysis, this is the basic skill to be a professional trader. If you don't know how to read a chart well, I'm sorry, it's the basic skill. It's like the basic skill of driving. Until you can drive, you can't go on a racetrack. It's just a basic skill. All right, and let's wrap this up with trade management. Now, this is going to take us all the way back to the start of this session, where I talked about the 10 trade analogy. Now remember, as a trader, you're only going to take the trades that you think are great. You're not going to take the trades you think, this one stinks. You're never going to take those. The only trades you're going to take are the ones that you think, I did everything right. I looked at the calendar, I planned out my trade, I did my relative strength and weakness, I found the correct pair, I waited for a high base breakout, it's breaking out, and you're going to take that trade. Here's the problem. Some of them are going to fail. Some of them are going to fail. And some of them are going to take off and run. And you have no idea which one is going to do it. You have no idea. Now look, every time you click that button, you think this is going to be the one, but sometimes they aren't. So you need to make basically a plan. What is your plan for if it doesn't do what I think it's going to do? How can I get out my capital out of the market without taking that big of a loss, an acceptable loss? And if it does go my way, how can I hold on to it and squeeze as much money out of it as I possibly can? Because studies have shown that the average trader, and again I'm going to use amateur trader, is actually pretty good at getting into a trade. They're terrible at getting out. They did studies, 59% of the trades made. There was 12 million trades of amateur traders they followed. 59% were winners. The problem is only 6% of the accounts made any money. Why? Because the average winner was about 58 pips, 59 pips, and the average loser was 126, I think. So they held their losers and sold their winners. So we want to make sure that everyone here designs a really good trade management strategy. And at Maverick, we use the concept of a trailing stop. Now, a trailing stop is an actual order. You can actually enter an actual order that is a trailing stop. And the way the trailing stop works, if you aren't familiar with it, let's say you bought the currency at 132.43. You could put in a trailing stop. So let's say you put in a trailing stop for 30 pips. Now what that means is that if this currency goes down to 132.13, you get stopped out. That's where it starts at. That's the very first stop level. However, if this goes up to 132.44, goes up 1 pip, guess what? Your stop goes up to 132.14. And if it goes up again another pip, your stop moves up another pip. Now again, that stop will never go down. It never goes down. So if there's ever a 30 pip pullback, you're out. But if there isn't, and this thing runs, once at 133.87, your stop is going to be at 133.57. Now this happens automatically if you use the automatic order. You could see here, on the ones we're wrong, we get stopped out, we lose 30 pips. The ones we're right, if they keep running, we potentially could be in them until they actually finally hit a certain point. Let's say the high is 134.95. At that point, our stop is at 134.65. And it finally drops, we get stopped out here for a nice gain. This is the trailing stop. Now, like I said, there are automatic buttons. We don't really like the automatic buttons. We really like manually moved stops. We like to tie these stop orders to a technical indicator. So this is just picking a random amount of pips. They don't mean anything. That's not intelligent. That doesn't mean anything. Should you pick 30 pips? Should you pick 32? Should you pick 38? Guess what? Flip a coin, I don't care, because it's all meaningless. What we like to do is we like to get into a position, and then we like to put in a stop and then tie it to an indicator. tie it to a moving average, tie it to a parabolic SAR, tie it to something to where as long as it goes our way and it doesn't violate what we don't want it to violate, we're still going to be in the trade. Regardless if it goes up or down 30 pips, it doesn't matter. We're tying it to something else. So let's just quickly take a look at an example. Your next session is going to be the FX Master session, where you talk about this quite a bit in there. So I just want to kind of cover the concept. So here's a trade. This is one of our trades here. This is called a bullish reversal. So the entry would be at 180.77. And let's say that the initial stop is placed at 180.27. That means there's 50 pips of risk. Now again, this is a Japanese yen cross. So remember, the yen is priced a little different. But this trade has 50 pips at risk. Now, one of the strategies you can use, it says, okay, I'm going to leave my stop here at 50 pips until I have 50 pips of profit, which means until this trade gets to 181.27, I'm just going to sit and leave my stop here at 180.27. So again, this is a position management strategy. Once I get an amount of gain equal to my amount of risk, which was 50 pips, your next step is going to be to move it to break even. Again, I love to move a stop to break even. I love that. Now look, sometimes it is going to come down to break even and you're not going to make any money and you had a profit. And yes, that will annoy you. But don't worry, you will be justly compensated by following really good position management strategies like this. So again, number 1 was initial stop. Number 2, move to break even. And number 3, after break even, you're going to tie your stop order onto what's called a parabolic SAR. Again, this is a technical indicator. You may not know it yet. Don't worry. It's pretty easy. It's these dots. So look, right now you don't know what the dots are maybe, but I know you can see them, and I know you can see when things go below dots and when they go over dots. I'm very comfortable with that. So remember, here is the strategy. You get in, and look, if this one doesn't work out, it might go up a little bit, it might go down a little bit. If it fizzles out, you lose 50 pips. Take your money off the table, go on to the next trade. It didn't work out. It was one of the bad ones out of the 10. However, if it goes your way, as you can see at this point, it did not go up to 181.27, which is right up here. It used to go up to 181.27. It didn't go up to that point, so we don't do anything. Now, here's what the problem is, that when people see this kind of a move, it was looking so good, and now it's looking so bad, and you're screen watching. Don't deviate from your plan. Your plan is beautiful. It's perfect. If you apply this over 100 trades, you're going to be really happy. So once you see it go up above 181.27, which it just did right here, now we move up our stop to break even. At this point, you're either going to get a 0 or you're going to get a big gain. We don't know which one. And remember, the third one is once the parabolic SAR, which are these dots forming right here, once they move up above break even, I'm going to use these as a trailing stop. So it might come down, it might stop you out of break even. But as you can see here, during this whole run here, the price did not go underneath these lines or these dots. And you're just moving your stop up. You're moving your stop up. At some point, it will turn around. You do get knocked out. And you can see that was a 113 pip gain. It's a very nice little gain there on this trade. This is a great concept. We use this concept all the time. This is how you make sure that you have a good trade management system. And remember, all a trade management system should do should create larger gains and losses. You are going to make 50 trades, 100 trades, 200 trades. Who knows how many trades you're going to make in a year? Some of those are going to be losers. Some of those are going to be winners. Do you have a system that makes more on the winners than you lose on your losers? If the answer is yes, congratulations, you're a professional trader. And if you can just keep that up, you'll make a nice living at this. That's how it works. So let's kind of go through this again. Time and energy. You look at the calendar for the week. You plan out, okay, this one I'm going to trade. This one I'm not going to trade. You look at relative strength and weakness. Now look, you may start with the week with, hey, I think the Aussie is going to be strong. But let's say that on Tuesday, the Aussie is not strong. Reevaluate. Okay, what is strong? Well, it looks like the pound has actually been the strongest currency today. I'm going to start looking at the pound instead of looking at the Aussie for relative strength. And maybe, the Swiss franc was still weak, so maybe I'm going to take a look at the pound Swiss franc cross on Tuesday for the rest of the week. You find your pair, you look for a setup, and then you make the trade, and you work it in a way where you sell losers and you hold winners as long as you can. That is basically the path. That's just what you do, and you're going to do it over and over and over again for the rest of your life. It's actually quite fun. All right, hey, thanks for joining, everyone. Everyone, take care.